Hello, everyone, and thank you for joining today's web conference, the CNR 2024 Mid-Year Outlook. My name is Rachael Crane, and I'm a Senior Portfolio Manager at City National Rockdale, and I'll be moderating today's presentation. I'm joined by several key leaders from the CNR Investment Strategy team, including our Chief Investment Officer, Charles Luke, Head of Fixed Income, Michael Taila, Director, Investment Solutions and Research, Tom Ehrlein, and Director, Senior Portfolio Manager of Equity Income, David Shapiro. The views and estimates you hear today are sourced from our investment committee's weekly meetings. During our call today, our presenters will share their thoughts about what the second half of 2024 may have in store for investors and the implications for investment portfolios. At the end of the presentation, we will all be on the line to answer any questions we receive from you during the webinar, so please type them into your console's Q&A window anytime during the session. You can also download the presentation materials using the resources window on the right side of the console. I'll now turn the call over to our Chief Investment Officer, Charles Luke of City National Rockdale.
Great. Thanks, Rachel. Thanks, everybody, for joining us today. It's great to have you here. So what I wanted to start with is just running through everything we're going to talk about, and then I'll get right into the economy. But first, just want to talk about some market developments since the last time we were with you in May. Go through our forecast, talk a little bit about what happened with the Fed and inflation and jobs. Then we've got Mike Taila on to talk about our fixed income strategies, the update there, what we've seen so far this year, and what we can see towards the back half. And then I'm really happy to have Tom Ehrlein on to talk about opportunistic income. He's going to go through some of those asset classes, which is always good to check in and make sure that there's a general understanding of what we're doing in that sector. And then go into equities. So I've got David Shapiro on to talk about equity income, to go through that strategy. And then I'm going to finish this up with core equity. So to jump right into our speedometers, and if you haven't seen these before, what these are 20 different indicators that we believe influence economic activity broadly. And on a monthly basis, we score them on a scale of 1 to 10. So anything in the red zone here is a potential negative for economic growth. If you see something in yellow, it really means it's right in neutral or the middle. So there's no acceleration or deceleration. And then green is positive for the growth environment. So for the month of June, we didn't have any changes overall for this July update, but we are watching a few indicators that are getting pretty interesting. And we're having some discussions about those, including their direction. So the first that I would mention is monetary policy. So we'll talk about the Fed, but essentially the probability of an interest rate cut has increased this year. The probability of even seeing 2 is much higher. So we had some discussions this month about potentially increasing that dial, getting closer to green, but we decided that we want to see a little bit more data before we do that. The other thing that I would mention is what's happening in the labor market. We'll dive into that today, but that's an area where we're starting to see rebalancing and some slowing. So there could be some changes there. Housing is another speedometer where the past 2 months we've gotten some pretty interesting data. I'll dive into that on the inflation front. And then finally, the inflation dial in the bottom left. So we're seeing a return to a nice trend lower. So we could see that move a little bit further into the green over the next couple of months. And when we think about our forecasts, just to run top to bottom here, our real annual GDP growth for the full year of 2024 hasn't changed. We're still 1.75 to 2.25. Corporate profit growth, I'm going to give you an update on earnings in the core equity section, but that continues to be very strong, about 9 to 12% in our estimation for 2024. The one change we did make over the month was our headline CPI projection. So with inflation expectations moving in the right direction, we had a 3.5% top end to our estimates. We just brought that down to 3.25. So we think there is a higher probability we could see that 3% or potentially even lower midpoint by the end of the year. Core CPI for us hasn't changed. We think it's going to be somewhere between 2.5 and 3. And then we did make an adjustment to our Fed funds forecast. So very similar to headline CPI, we had still had a pretty decent probability that the Fed might not cut interest rates prior to the June meeting. And so we had a 5.5% top end range. We brought that more in line with just 1 to 2 cuts at 5.25. So we're 4.75 to 5.25, again, expecting those cuts to start in the back half of Q4. And then finally, On our 10-year Treasury note expectation, we're remaining between 4.1 and 4.6. We've been solidly within that range over this year. And so our analysts have done a great job with our models sort of forecasting fair value there. So we're going to stay between 4.1 and 4.6. So let's jump into the economy and really talk about what's been happening so far in the first half. So broadly, if you look at the green box, this was January, February, and March at the start of the year. So the data came in above expectations across a variety of growth, inflation, and jobs data. And that was a pretty big shift from how the trends ended last year. And we've had a structural change in rates and inflation. Those are very real. But if you look at the past couple of months, so April, May, and here through June, we've seen the reverse. So we've seen broad-based declines and missing expectations for a lot of the broad measures that we follow for inflation and jobs and other economic data. So today I wanted to discuss how the data has changed in the aggregate, kind of go up a level, and show how it's supporting this gradual slowing theme and a potential soft landing. So I still want to acknowledge that there are plenty of risks out there, but we don't see them as fundamental core economic risks at this time. So to jump right into the Fed, I think there were 4 takeaways from the last meeting. And so if you look at the left-hand side, this is the FOMC dot plot projections. So the Fed uses this to communicate how they're forecasting policy. And one of the biggest changes is they went from having 3 cuts expected in 2024 to going to just a single cut in 2024. So that is 2 fewer than they previously did estimate. It was significant, but it was very much in line with our expectations. And Powell did discuss a high degree of uncertainty related to how the projections could unfold. So they're still trying to hedge their bets a little bit. The second bullet on what happened in the meeting was there were very few changes to the Fed's statement, but they did slightly move up their inflation expectations, which was interesting. But Powell was quick to note that those adjustments were conservative in nature, and that suggests the Fed is hopeful that inflation will be lower than the estimates that they have out there now. And then I think the most significant comment that he made during the press conference was about the labor market, and specifically the labor market moving back to its pre-pandemic state. And so his statement was, we're kind of seeing what we wanted to see. That's a gradual cooling in demand and a gradual rebalancing in the labor market. So we tend to agree, and I'll talk you through that. And then the last point that I would make is it doesn't seem like much, but the Fed did move their long run expectation for interest rates to 2.8% from 2.6%. And it's not big to us, but I can tell you for the Fed to move 0.2% on an estimate is a pretty big move for them. So that was acknowledging that structurally rates are probably likely to be a little bit higher over the coming years. And then I'll also point you to the right-hand side of this chart, just looking at the real 10-year Treasury rate. I want to underscore that Fed policy is still restrictive. And so this is going to start to impact growth, and we're seeing the early signs of that. So let's dive right into inflation. Obviously, this is key to the Fed outlook, key to the economy. And I always like to go back to the top level and see what those longer term trends have been and where we've been over the past couple of years. So if you look at the left-hand side, this is headline inflation. The right-hand side is core inflation. But if we go back to the peak, CPI was over 9%. And if you can believe it, producer prices, so the prices that companies were paying to develop their goods, exceeded about 12% back in 2022. Core inflation was running at about 8%. So no matter which way you slice it, progress has been made on bringing the rate down. But the issue is the near-term trend. So going into last year, it looked like it was on a downward glide path. We got the spike in the data in the first 3 months. But we're starting to see that trend come back into the picture. We don't think it's going to be at 2% anytime soon, certainly not by the end of the year, but I did show that we adjusted that top end from 3.5 to 3.25%. Currently, CPI is at about 3.3%. But the reason we believe this downward trend has resumed focuses on services spending and then primarily housing. So if we break that down a little bit into some of the finer details, I think this really underscores the strength of the current trend. So goods inflation in the top left-hand side, this is what we pay when we buy something at Target or Walmart, it didn't budge in May. It actually moved at a 0% run rate. And if you look at the 3-month rate, it was actually negative. And then on the right-hand side in the top corner, you can see services inflation. That has been the sticking point. But it did print at just 0.2% in terms of the monthly advance. And there was a sharp change in the 3-month trend, falling from north of 5% towards 4% in May. And that's important because we talk a lot about housing prices and the impact that it's going to have. But even if housing prices don't budge, other areas of the service sector, and we saw this in May, can create enough downward pressure to continue to move the trend lower. And even if they don't move at all, if housing prices just stay the same, the annual run rate, the change in that will continue to moderate. And that does assume that other parts also slow. But the point is that housing prices can be stable, not move, and we can still see positive trends in the inflation data. But I think it's important to underscore what's happening in housing specifically. And I think it, in the aggregate, is pointing towards lower activity. And the past few months have been really telling. So if we start with what we got just last week, housing starts, so how many construction projects are kicking off, and building permits fell in May by nearly 6% and 8%. We got new home sales data yesterday showing that home sales month over month fell about 11.3%. And it's still pretty tight, but existing home sales inventory has actually spiked by about 29% so far this year. So it's been historically tight, but starting to see some loosening there. So I think that definitely shows it's on a downward path. And even in these bottom two graphs with core CPI excluding housing, and then CPI including shelter, and then the Zillow rental index, which is more real time, you can see that those trends are starting to move a little bit lower. And it's also important to know that housing is 36% of the CPI number. So even if we get just a small change in adjustment in that, let's say it goes from 0.4 over the month to 0.3, that's going to have a big impact in the overall trend. The next aggregate that I wanted to talk about is the labor market and what we're seeing in terms of loosening, a lot of what Powell talked about. And so we definitely agree with the Fed that progress is substantial in the job market. To go through each one of these charts, if you look at the top left-hand side, that's the overall level of jobs added every month. So it's slowing back to normal trends, clear path there. If we look at the job openings rate, this is in the top right-hand side, it's back to its pre-pandemic levels. And then the quits rate alongside of wage growth, this is in the bottom right, continues to drop really quickly. But the most significant aspect is what's happening with the number of jobs available per worker. You can see this in the bottom left-hand side. And what we had over the past few years was that there were more openings than people looking for jobs for a long time after the pandemic. But now as these job openings have declined, it hasn't led to a higher unemployment rate until we kind of got to this pivot point. And so the large excess of job openings that we had meant that any person that lost their job could quickly find another one. And so companies, because of that as well, didn't want to lay off people. It was very tough to find workers and very difficult to fill any vacant positions. But today, the situation is different. The job available per unemployed worker has actually returned to its pre-pandemic levels. So jobs are no longer as abundant as they were previously. And that suggests that any further decrease that we see in job openings could result in higher unemployment, since there's not as big of a buffer to absorb these excess workers. So to summarize it all on the job front, I believe it's safe to say that it is now back into balance, and we'll certainly be laser focused on the data over the next couple of months to see what sort of trend will break from here. And then the last component on the economic front that I wanted to address up front was some of the consumer preferences that are changing and what we're seeing in spending. And I found this really interesting over the past month, but we're starting to see a little bit of a slowdown in the overall rate of consumer spending. If you look at the left-hand side of this chart, you can see we were above 3% in 2023, fell to about 2% here in Q1, 2% Q2 estimated, and then a slight decline to kind of the mid ones as we wrap up the year. So it definitely is starting to slow a little bit, but still positive, supportive of this gradual growth slowdown. But on the right-hand side, this is what's really interesting. If you look at the gray, that's the percentage change in unit sales for national brands. So something like Boar's Head Turkey. If you look at the navy, that's the store-bought brand. So whatever the turkey is you're going to be buying from Kroger, that's increasing, while the national brands have actually decreased. So it's very nuanced and slight, but sales are still increasing. And it does suggest a more budget-conscious buyer. So just being a little bit more careful with how they're spending money. So I thought that was very interesting. And then the last thing that I want to talk about today is global volatility. And I do think this is a great data point for November. And I'm going to run through some of the near-term potential moves that we could see during the election in the short term. But I mentioned this back in May in the webinar, and so wanted to do a quick review. So the Mexican elections, and you can see that in the actual yellow on the chart on the left, mostly as expected. There's concern over constitutional amendments. So that actually drove the market very shortly after the election down about 5%. If you look at India, that's in the lighter blue on that chart. It got a little bit more national attention here, mostly negative national attention, because Modi did not win a majority in parliament. But the market actually fell 7%, only to recover fully and then have a cumulative total return of about 4.3%. So a very wide range there. I think we all know the issues that happened in France. That sent equity markets tumbling there. So France is down about 6.7% over the past quarter. But what we're highlighting here on the right-hand side is the jump in bond yields, which was significant. So elections just don't impact the overall equity markets. We can see impacts that filter down into rates, currencies, and other areas. And so with France, we're going to see those snap elections in just 3 days. So the good news is that the spillover impacts from these events in the US have been limited, but it's certainly been hard based on this turn to look at non-US investments and look at them as the place to be right now. So we're going to stay US centric. The one data point that's good as well is that we won't see any other global elections, any major ones, until we get to the US election in November. So in a sense, this global sequence of elections has now been passed to the US. So just to briefly hit the high points, and then I'll pass it off to Mike. The April and May data releases do suggest that a moderation in growth is underway in inflation. If we look at the Federal Reserve, we do think they're going to cut interest rates this year. It's pretty much a certainty that we're going to see one, but the probability has increased. We could get two, maybe one before the election and maybe one after the election. When we look at inflation in the job market, we do see signs that inflation is slowing and that the job market is rebalancing and potentially back to full balance. We also talked about consumer preferences shifting, reflecting a more budget-conscious buyer. And then I ended with just global elections, some of the volatility that we've seen there, and the data point really being indicative of what could happen for us in November. So I'm going to stop there, and Mike, I will hand it off to you on the fixed income side.
Great. Excuse me. Thanks, Charles, and hello, everyone. So turning to the fixed income markets, why don't we start with the 10-year Treasury? And as you can see from the chart on the left, the first half of the year has been a story of volatility, with rates starting the year at 3.88%, moving higher on concerns of lingering inflation to touch around 4.70, and then only to decline again to around 4.28, where we are this morning. So with rates up approximately 40 basis points on the year, returns on the broad Treasury market are only down by about 14 basis points through the middle of June. And to the right, we show returns across various sectors of the market, with intermediate municipals down about 50 basis points, intermediate corporates are positive, and then the best performers are in the high yield space. And then if you look at the light blue bars and the yields available in the market, we continue to believe this presents a good opportunity for fixed income investors. So aside from these bouts of Treasury volatility, technicals have been a meaningful impact on returns this year. And the chart on this page shows fund flows. And so those are the dollars in and the dollars out of fixed income mutual funds. And we can see that 2022 broke records with over 500 billion leaving. And this was driven primarily by the aggressiveness of the Fed. And this caused fixed income investors to exit the market, with many parking cash on the sidelines, just enjoying rates, on the front end of the curve. But by 2023, and especially into this year, with the Fed on hold and attractive yields across the curve, investors are becoming more comfortable. And as a result, we're starting to see buyers enter the market again. And so when we look at the breakdown, we've seen about 115 billion come into the market this year. And the flows have been concentrated in intermediate maturities and high yield. And that's across both the taxable and tax-exempt markets. Now, the fund flows that we're seeing have been counterbalanced with a large increase in new issuance. And so on the left, if we look at the investment grade and high yield corporate markets, we can see that supply is tracking well ahead of where it was at the same period last year. And we do expect supply to be higher than what we saw in 2023. Now, a few things are driving this uptick. So issuers are taking advantage of tight spreads and strong credit quality to refinance older debt. But then we've also seen an uptick ahead of the elections in the fall. So issuers are looking to avoid potential market volatility. And this isn't unusual. It's a pattern that we've seen before, where the second half of the year, it tends to be much slower than the first half during election years. And on the right, within the municipal space, issuance is up close to 40% versus the same period last year. And here, supply is being driven by refi activity and some re-emerging capital needs as pandemic aid winds down. And so what's nice about what we're seeing in the muni market about this increase in supply is that after many years of very tight supply, we're having a much easier time putting funds to work at what we think are attractive levels across the curve. And so I mentioned that we had this uptick in corporate supply that's been driven in part by strong balance sheets. And in order to get a better picture of credit quality, the chart on the left looks at defaults within the corporate bond market. And historically, default rates tend to be extremely small within the investment grade sector of the market. And so what we're looking at here is primarily high yield. And what we see is that corporations through the pandemic and as rates have moved higher have prioritized balance sheet strength. And as a result of this, default rates are below long-term averages. And where we are seeing some distress, it tends to be very concentrated into only a few sectors of the market. And so this strong credit quality is being reflected in the chart on the right. And here we're breaking down yields by credit rating. And what we notice is that the credit curves are relatively flat. And this is primarily a reflection of the quality we're seeing across the market. So in addition to this, with investment grade yields at plus or minus 5%, and then you have this pronounced jump when you get into the high yield market, we see attractive opportunities across this curve as well. And then when we look at the muni market, we've also experienced improvements in quality. In the muni market, we do tend to look at things a little bit differently here. So rather than looking at distress as a percent of the market, in munis, because so few defaults happen, we tend to look at the actual numbers of issuers that are experiencing defaults for the first time. And so as you can see on the chart on the left, the number of defaults has declined since the pandemic, and it's tracking below long-run averages. And again, it's very similar to the corporate market. So when we do see problems, they tend to be confined to a few sectors of the market, and it's the non-rated part of the market where we tend to see them. And then on the right, we look at yields across the muni credit curve, and then we're adjusting these also to account for high tax brackets. And here again, the credit curves are pretty flat, reflecting the overall quality of the market. But with yields north of 3%, right, this does make for attractive taxable equivalent yields, right? And a reminder that the taxable equivalent yield in this case is the yield that you would have to earn on a US Treasury in order to equal the municipal yield at the highest federal tax bracket. And so we've covered credit conditions and the credit curves. And on this page, we turn our attention to focus on yields across the various fixed income sectors. So at the left, we see short yields that are anchored by the Fed at 5.3%. And then if we move to the right into segments of the market that have longer maturities, we see investment grade yields in the 5s and high yield close to 8%. And so the primary message here is that with yields at these multi-year highs, it's income that's going to drive performance, and it's income that can cushion portfolios during periods of volatility. And so as we approach this turning point in Fed policy, history shows us that cash or very short tenors in the market will start to underperform longer maturities. But what we see is that investors that might have longer horizons, they tend to be a little bit hesitant to move out the curve. And that's either because they continue to enjoy these higher cash yields that they're seeing, or because they are concerned around some of this volatility. And so on this page, this looks at how the income can help drive returns and provide a cushion around this volatility. So each section here, it represents 3 segments of the corporate market. So the first includes short corporates with 1 to 3 year maturities. These yield around 5.3%. The middle reflects intermediate maturity bonds yielding around 5.4%. And on the right, it's the broad market, which is yielding around 5.5. And for each of these, we run 3 scenarios to see how returns would be impacted if rates don't change over the next 12 months, or if rates increase or decrease by 1%. And the dark blue and light blue bars break down the primary sources of return, income and price. And so if we focus on the center part of this chart, as I mentioned earlier, it's these intermediate maturities that have been one of the primary areas attracting flows into the market. And I really think this helps explain why. So if we look at that no change scenario where rates remain constant, we can see that forward returns are approximately 5.3%. And this is driven primarily by income. But if rates increase by 1%, we would expect to see some price decline, roughly around 3%. But that 5.5% income we're receiving is going to absorb much of this, and forward returns are still positive at just over 2%. And then if rates decline, we have price and income combining for a total return of 8.7%. And so the key takeaway here is that risk reward appears to be fairly balanced, right? High starting yields are offering downside protection, and modest extension from the very short part of the curve has the potential to offer attractive upside, especially as the Fed begins to cut rates. And so to summarize, right, our view, our higher for longer thesis, it remains intact. So we're starting to see investors take notice of the attractive rates that the market offers, and they're starting to look beyond cash in anticipation of Fed rate cuts. And we continue to believe that a resilient economy is going to continue to support solid credit fundamentals. And with that, I will turn it over to Tom. Thank you.
Great, thanks, Mike. That was excellent. Some of the themes that you covered, I'll carry on a little bit during this segment. First off, it's a privilege to be here today on the webinar. Looking forward to covering what I view as some of the more interesting areas of our client exposures, specifically opportunistic income. For this call, we're going to for this section of the call, we're going to cover U.S. high yield bonds, floating rate loans, emerging market debt, private credit or direct lending, and structured credit with a focus on collateralized loan obligations or CLOs. In my time slot, I look to cover 3 main topics. First, performance since the start of the Fed rate hikes, and then second, performance year to date. Then I'll transition that a little bit to outlook moving forward in all of these different segments. So in the first 2 key points, you'll see some details on this slide on historical performance. Again, wanted to point out two key time periods. When the Fed first started hiking rates in Q1 2022, and then more topical, or probably what's more on people's mind as we're halfway through the year right now, performance year to date. So this high level summary in terms of the data is segmented quite a bit, as you can see, from the top half and the bottom half. Segments with floating rate income have outperformed pretty significantly since the beginning of 2022 when the rate hikes began. This might seem rather intuitive that rate hikes would benefit from a floating rate environment, but and while we agree, looking back to early 2022, not everyone had their crystal ball out expecting that outcome to be the case. A lot of people thought a recession was imminent. People wondered if companies could pay their debts with higher interest rate costs. Well, both the recession question and higher interest rate question have been answered a bit, with CNR and consensus chance of recession probability now being quite a bit lower, and companies across the board thus far have been able to successfully navigate a higher interest rate environment. We see the impact with strong returns in areas at the top of this chart, like CLOs, with cumulative benchmark returns over 30% since the start of 2022. In terms of year to date, the strong performance has continued in the floating rate asset classes. But as you can see in the brighter blue lines on this chart, we've seen a little bit of a broadening of performance, with US high yield catching a bid as of late and strong year-to-date returns in EM corporates close to 6%, which have been lagging quite a bit over the past 2 years. So moving to the next slide, reviewing performance is always nice and important part of our discussions, but what we always view as most important is what's here and now and what our expectations are in the future. On this slide, we take those same two time periods, the beginning of 2022 and currently, but we switch it. Instead of returns, we're looking at where yields are. So historical, but then current as well. I won't really go into details on the different market segments on this slide, since I'm going to be covering every kind of a carve out of different pieces and everything. But it's clearly obvious if you look at the dark blue versus the light blue, current yields are higher than they were in almost every market compared to 2.5 years ago. This might be obvious, but it leads to potential opportunity. From a yield perspective, and at this point in the cycle, these levels of considerable interest payments for investor could offer great buffers to offset potential volatility. Again, the next few pages, I'll go into some details on that. So EM high yield corporates. We have perpetually higher yields in developing markets on the emerging market side. However, this, at a lot of periods in time, comes with greater uncertainty. As shown and as discussed in the prior pages, we have had strong year-to-date returns, and our beginning of the year thesis was a potential for spread compression in this market. It's pretty much played out this year, and that's why you see a disconnect between higher returns in EM than the US high yield space. With that greater returns and spread compressing, we feel this brings us back to somewhat of a neutral outlook in the space. This market in general is a lot different than emerging market equities, but there are some unique aspects to consider from a credit perspective. Overall, there's less coverage that leads to opportunities on a security selection basis. One of the things that mentioned on this page in the bullet points is something known as the sovereign ceiling. This is the idea that a fantastically run company might be hamstrung by its local government bond rating, and there might be a quality mismatch. Excuse the background noise for a moment. So again, we've seen this play out for the first half of this year quite nicely with spreads compressing, but at 8.5% yield, we don't see dramatic upside versus US high yield in terms of but it still is a nice carry. So then just on to US high yield. This is always a bellwether for us in our client's portfolio. The theme is the same here as what Mike brought up and what I've been speaking to in the beginning, elevated yields. However, historically, there are limited time periods where high yield bonds have underperformed floating rate loans on an extended period of time. We believe that we're kind of at the tail end of one of those unique time periods. As I mentioned, floating rate notes and bonds significantly outperforming for the past 2 years. At the tail end, timing is a little bit uncertain, but from my perspective, a reasonable stance on that is in the next 6 months, loans could slightly outperform before giving way to a catch-up in high-yield bonds early to mid-2025. At that point in time, we'll have an even clearer picture on potential rate cut scenarios, and there could be considerable upside for fixed-rate high-yield bonds. But as the rate hiking cycle peaks and our macro view on the economy adjusts, potentially improves, this is typically a good starting point to invest in fixed-rate US high yield. Stepping back in general, why do we invest in this asset class? Well, clearly you're taking on some risk, but you're typically commensurated with a little bit of additional return, as well as diversification in client portfolios. Now, going back to that focus on loans. Loans certainly have been on a nice run as of late and currently have a higher yield than what's out there in US high yield bonds. We feel the space can continue to deliver contributions to client portfolios. Two interesting considerations that we're looking at quite intensely in this space is how the seniority and the capital structure will play out moving forward. What we have seen is a much lower default rate. But another thing that's been interesting is those poorly run corporations that have defaulted in the loan market have had much lower recovery rates. Historically, if a loan defaulted, the expectation was you should receive around 80 cents on the dollar in terms of claims on the assets. And general, since loans are issued at cov-lite structures now and other dynamics, there's less assets for collateral associated with it. So we've seen that come down significantly. Again, the flip side of that is there's been far less defaults and ability for flexible adjustments on the credit rating perspective. Now, onto another area within private credit, direct lending. This market's been in the news quite a bit, and for good reason. It's expanded significantly, become more mainstream. Some have voiced concerns with the expansion, and while we are aware of potential challenges, we also see opportunity. Corporations have enjoyed the flexibility of partnership models with direct lending firms, avoiding costly and highly regulated processes with large banks, and the flexibility is saved on lending costs, allowing borrowers that are willing to work directly with private credit firms these benefits. While this remains an elevated area of yields, we are seeing other markets catch up. And overall, this is providing a more well-rounded market for all opportunistic income to operate. But we believe the stability of this market to continue. And just wanted to clarify, we do not see this as a risk-free asset class by any means. It should be considered potential for volatility like other areas. It just so happens that historically and more recently, there's been very little volatility. As mentioned on the first page, year to date, investors have seen close to plus 6% returns. And in the past 2 years, we've been in the low double-digit ranges, around 12 to 13%. Future returns might come down a bit because of the floating rate nature and obviously the Fed hiking system and other things like that. But we continue to see this as an area to outperform traditional fixed income markets for the foreseeable future. The last area that I wanted to focus on within opportunistic income, specifically in different markets, is structured credit or collateralized loan obligations. Investors in this space have had pretty solid returns for the past few years. We're already up above 12% in terms of looking at the lower credit quality areas of the benchmark, and a very appealing income stream to match that. Those returns are available for a few reasons. It's not yet a widely held asset class by individuals. It's mostly institutional, even though that is starting to change a bit with some ETFs and other groups coming into the market. It's still a huge percentage that's mostly well run on an institutional perspective. As in terms of the underlying markets, the CLO structure allows for workouts of dislocations and protecting multiple segments of investors. There's also a slight illiquid premium that helps booster the returns a little bit. But while the market does trade during periods of dislocation, patience is definitely required in this space to compensate for those returns. Wrapping up with some key takeaways, we're looking at these types of investments to diversify our traditional offerings in a 60-40 portfolio. They deliver things like areas of higher income streams to our clients, and the investments that we're evaluating and looking at, we're looking to provide performance in both a rising and falling interest rate environment. One caveat is that they're very dependent on macro market movements, and volatility might be slightly elevated during periods of uncertainty. But as mentioned, this is sometimes offset by clipping higher coupons and allowing for reinvestment opportunities during these periods of dislocation. So thank you for the time during this, and I'll pass it over to David Shapiro to cover some aspects of equities.
Thanks, Tom, and hello, everyone. At a high level, I'm going to discuss what equity income is and can be expected to provide to clients, and how we position the portfolio to transition this current period. So to start, let's review the attributes of equity income as we manage it here at CNR. Our investment objective is a dual mandate to provide both attractive income, yield, and also equity capital appreciation. By attractive, we mean well above the average income you can get from a typical equity portfolio, a multiple of the market's yield currently, and above that of a typical dividend portfolio. Over its history, the universe of stocks we play in has yielded an average of 4%, today about 4.5%. That dividend universe consists of companies that are generally farther along in their life cycle than the market cap weighted broader market, and it is, relatively speaking, distributed in more defensive industries. Think utilities, think consumer staples, and it consists mostly of stocks that are considered value stocks. The average PE of our universe is about 12 times forward earnings, so keep that in mind when Charles takes you through market valuation later. It's also broader in terms of market cap, company size, and therefore on average smaller cap than the market, although it does include mega caps like Coca-Cola, Procter & Gamble. And the strategy focuses on relative quality, something that is crucial in ensuring that we are invested in companies with dividends that are sustainable and stocks that should outperform over time. Better business franchises, margin structures, free cash flow prospects, management. That's how we differentiate our portfolio versus the available universe. So what benefits does it provide clients? Why would equity income be a part of your overall equity allocation and solution in service of your investment goals? Well, income for one thing. It can certainly contribute to the overall level of income that a diversified portfolio delivers. And while delivering that healthy yield, it also contains equity optionality, the potential for value gains over time as value accrues and our stocks appreciate. Equity income is not fixed income. What that also means is that its income grows, and it has grown historically at a mid-single-digit annual rate, and the 7% annual rate over the last 10 years, which means two more things. First, it can help hedge that income against inflation, something that fixed income can. And second, helps compound the value of the portfolio over time. And the final attribute I'll mention is that it diversifies the equity holdings of a portfolio. As I mentioned, it adds more value, more diversified sector and market cap exposure, which can help moderate volatility when the market's hit a rough patch. And what should equity income deliver over time? Our framework for thinking about the total return to expect from the strategy is to start with the income, that 4% long-term average yield. And over the long term, dividend yield is accounted for approximately half of dividend stock total return. The other half of total return is equity appreciation, which comes from a mixture of earnings and dividend growth, true value accretion, and any change in valuation. And so we have a total return framework of 6 to 8%. And so far this year, we've had a nice rebound in the equity income strategy, which is looking good on a relative basis. Now, to go a little deeper in the nature of our dividend universe, I mentioned earlier that dividend stocks are more defensive than the broader universe. Here you can see part of the reason why. For one thing, the key defensive sectors of utilities, consumer staples, telecom, they account for more than 40% of the dividend universe, much more than the broader market, for which these account for less than 10%. And what we see in the chart is that the three sectors we're looking at here, in addition to being defensive, are also higher yielding income sectors. They have historically been most impacted by changes in interest rates, rising when rates fall and declining when rates rise. And that's especially pronounced when rates abruptly shift course. And we've seen some pretty rapid rate moves in recent quarters amidst an upwards trend. So during the last 6 cycles of trough to peak moves in the 10-year over the last 25 years, these sectors have seen mid-teens underperformance. But if rates are finished rising at the pace and magnitude seen over the last few years, at minimum, that should remove a significant headwind. And if rates do start to decline, which can coincide with Fed rate cuts, well, historically, peak to trough moves in the 10-year have led to mid-teens relative outperformance. And if that's driven by macroeconomic weakness, well, that could be another reason for these defensive sectors to outperform. Now, I'm not predicting that will occur, but I want to help you understand some of the drivers of our dividend stocks, at least on the margin, and why they act to diversify an equity portfolio. Now we'll get a bit into how we've positioned the portfolio over recent quarters for this challenging environment of high uncertainty and elevated risk. I already took you through the strategy's characteristics. We continue to maintain a relative quality advantage versus our dividend stock universe, dividend quality especially. That hasn't changed, and it won't change. It's fundamental, no pun intended. The number one way value gets destroyed within the attractive dividend universe is when a stock cuts its dividend. We use all our tools, quantitative scoring, fundamental work, and years of experience focusing on high dividend companies to avoid the cuts, and we've continued to have a lot of success there. So our stock selection focuses on high quality companies with resilient cash flows and stable to improving dividend health. We've been in an environment of rising or high rates for a few years now, and we shifted towards biasing dividend growth over dividend yield, all else equal, ahead of rates bottoming and since. That helps us hedge our income against inflation and supports portfolio value growth. And given the uncertain environment, full of mixed and changing signals, we have reduced relative risk in recent months by adding some cyclical exposure. That has taken the form of lowering tracking error, moderating what had been a modest defensive tilt to be much closer to neutral, and reducing individual sector and position over and underweights, also closer to neutral. We aim to balance maximizing upside potential while maintaining sufficient downside protection. Again, always striving to avoid the dividend cuts that are so destructive of value. And here you can see the most important sectors of the strategy and how it's positioned relative to its universe. I mentioned we've been outperforming so far this year. That's been a function of stock selection, which I do attribute to our focus on relative quality. That's been most pronounced in financials and consumer staples, two of our largest sectors. The impact of our overall allocation among sectors has been net neutral, which reflects our overall positioning closer to neutral. And as you can see, our mix of underweights and overweights are distributed across a mix of both defensive and cyclical sectors to get there. We believe we've optimized to take advantage of some of the cyclical upswing we think may emerge over the next 6 to 12 months while keeping sufficient protection if the economy does take a leg down, and all while keeping our commitment to quality. So to conclude, I took you through equity income's dual mandate to provide attractive income and total return, and a few of its attributes that may help clients achieve their investment goals in different ways. Income, some inflation protection of that income and portfolio value, and diversification. I discussed the focus on quality companies, sustainable cash flows, and dividend income and growth, current positioning, close to neutral, slightly defensive versus our universe as we navigate a dynamic economic and market environment. And our year is tracking positively, and we're looking good on a relative basis. So I'll leave it there and turn it over to Charles to discuss core equities.
Great, thanks, David. So when we take a look at the broader market, just want to dive into a couple of different points here to wrap us up. So first, we've shown this chart a few different times, but I do think it's a great way to characterize exactly what's happening in the market. And so if you look at the green box and how that contributes to overall total return, it has remained very concentrated. But if you look at the yellow box, more sectors are now participating in higher than average positive returns. But there's been a lot of debate about the differences between this. So just wanted to discuss that really quick. What happened was the last time we spoke with you in May, everything in terms of participation and breadth, it was showing progress. And we believe that will be a key to the rally continuing beyond the near term. But just as soon as we started to see that and made those comments, growth stocks outperformed value over June by about 10%, highlighting the impact of the concentration on the S&P. So it's kind of flip-flopping a little bit. But when we showed this chart last June, that yellow circle was actually red. So most sectors were in negative territory or flat on the year. And the technology sector at that time was outperforming by nearly 40%. But if you look at year-to-date 2024, most sectors have now moved up about 5% or more, and information technology is outperforming by half as much as it was in 2023. So breadth did narrow over June, but we are still optimistic that valuations and the overall health of the economy will help to broaden the rally more substantially at some point in 2024. So let's shift and talk a little bit about valuation. It's been a tricky component of this market. And with all the tremendous returns that we've seen from tech over the past 12 months, 8% of the S&P 500 over that time period is still in a bear market. So when we exclude the Magnificent Seven names, the S&P is trading at an 18 times multiple. The equal weight is trading at a 16 multiple, and the S&P is trading at a 21.2 multiple overall. So it's really all over the place. But a decent proportion of this market, nearly half of it, carries more attractive valuations relative to history. We do think that's a good thing. And by finding pockets of the market that have trailed, where we do have high conviction, and then balancing that exposure to the tech stocks that have been leading the charge here, we do think that that creates a lot of confidence in our positioning. And we've also seen some signs of life in the very short term. So when NVIDIA took a brief stumble last week and early this week, we did see some outperformance in value, small and mid-cap stocks. So the main takeaway is that the market does have a little bit of a built-in cushion here if the market leadership does start to break down. The other component of valuation that I thought was interesting was that the market does change over time. The composition is different. Themes change, businesses grow, it adjusts. So if we take the same sector weights that we have today and we apply that back to the tech bubble, it does suggest that valuations are stretched in the aggregate a little bit, but not necessarily in the sphere of excess. So still well below the 30 times based on sector composition we would have had during the tech bubble in 2000. And I reminded everyone of this last time in May, but I do want to underscore the concept because I do think it's very important. So on the left-hand side here, valuation itself is not a good predictor of short-term returns. And you can see that none of those dots on the left-hand side are close to that line. So there's really no relationship there whatsoever. to the 1-year return. But if we shift to the right-hand side and look at the longer-term impact, valuation does matter a bit more. And you can see a lot of those dots are closer and tighter to that line over time. So a market like this really requires a steady hand, and what really matters is the full composition of the portfolio. It's not likely that we're going to continue to see annualized returns in the equity market based on the valuations today of 13% or more, but it's also not likely that we're going to enter a long-term bear market where returns are perpetually negative. So we believe, looking out about 10 years, that high single-digit returns are the most likely, given where the market is now. And a quick earnings update. The S&P earnings recovery at this point continues to improve. So if we look back, it's really shaken off the earnings slump that appears to have ended back in the second quarter of 2023. And if we take a quick checkup on Q1, EPS overall came in at around 8%. That was more than 3 times analyst expectations for just 2.5% growth. And that's the strongest beat that we've had since the first quarter of 2021. And compared to the last 4 quarters average of 3%, the S&P estimate is 11.3% for 2024. So that's a huge step up. There could be some headwinds as a higher bar is set going into the back half of this year. We have analysts for both July and October reporting seasons north of 8% and projecting a double-digit start to 2025. So that also backloads it a little bit for 2024. But notwithstanding those estimates and the higher bar, if you look at the breadth of earnings, leadership that could start to happen from the cyclical sector, easing inflation, and solid growth, that all points to underlying foundation for the earnings picture to be very successful over 2024. And so we're a little bit lower at 10.5% relative to the broad market at 11.3%, but we think it's going to be a very rich environment for earnings as we move forward. The other component that I wanted to talk about was just characterizing what sort of volatility we could see in November during the election. So I've tried to focus on the long term. We've talked about the triple T's, tariffs, treasuries, and taxes. But I get the question a lot about the short-term impact on the market from the election. So over the past month, we did go back to the drawing board and we took a look at what expectations could be 30 days prior to the election and then 30 days after. And that's what you're seeing on this chart. And what we found was pretty interesting. So if you look at pre-election returns, this is the 30 days before the election, they are pretty concentrated and between about -1% and 1% in those 30 days leading up to the election. And that points to a market being a bit more cautious and a lack of large bets that may be coming in with an unknown outcome. I definitely say we're in that type of a situation with the election in November. But then post-election, things start to get a little bit more interesting. And if the global elections we've seen here to start the year are any evidence of that, Mexico, India, Europe, they all suggest that volatility is more likely to occur after the election. So if you look at the right-hand side here, excluding the 2008 recession, there were 7 observations of negative returns below 1% 30 days after the election. Now, there were 16 instances of positive returns. So we're trying to set our expectations somewhere around a potential 5% temporary drop, which would be in line with recent global elections if it breaks negative, if there's high uncertainty. But we're kind of thinking somewhere between 1% to 3% on the upside if it is quieter than expected. And both candidates in the election in November are more known this time around, but policy uncertainty is likely to cause some indigestion. And we may actually get a relief rally if the election is less contentious and more clear-cut than we do expect it to be. So multiple different outcomes, but those are the types of ranges that we're expecting. And then to touch briefly on the CNR core equity positioning, the biggest change for us over June was increasing our communication services exposure. You can see that all the way on the left-hand side and moving to an overweight position. So for us, this helped us achieve our target exposure to the ongoing AI theme, and it did reduce some of the volatility relative to the S&P 500. And then just to touch on information technology, you can see that all the way on the right-hand side as an underweight. Within that universe, we still maintain a semiconductor overweight of about 2%. And the little known fact in information technology is that software, a pretty large component, has not kept up with the broader tech rally. So while we see most of the high flyers in tech, they're often very concentrated. They are very concentrated. So it doesn't really give you a taste for how the rest of that sector is performing. And then we have continued to increase some of our cyclical exposure, primarily kind of getting a little bit more neutral to information technology and communication services. And then I think what's very interesting is what's happening in healthcare. So we've had an overweight there, and we do expect high growth in this sector, partly because of the theme and what's happening with weight loss drugs. which is getting a little overshadowed by what's happening with technology and AI. So when we summarize everything and kind of look back on my comments, the stock market does continue to experience a lopsided rally. And that's despite some of the very short-term sector rotation we've seen here recently. We do believe that broad valuations really don't tell the full story. And many companies to us are trading at attractive and what you could even classify as lower valuations. We've seen similar sector weightings when we apply that to the tech bubble that would have resulted in significantly higher valuations. So we don't think those comparisons are appropriate. And then last with valuation, we don't think that's a good predictor of short-term returns, but we do think it can help guide our approach and our thinking around longer-term returns. And then for earnings, continue to move higher for 2024. It looks solid, and that indicates very strong business momentum. And then we're likely to see some volatility around the elections, which we've been talking about a lot. But overall, we think it could break either way, but we're kind of looking in between this range of potentially -5 if it breaks negative, and maybe an upside of 3% if it's quieter than expected. And then the last thing on portfolio positioning is that we've taken steps to reduce the volatility to the S&P 500, and we still maintain quality, and we've increased our diversification a little bit. So I'm going to stop there. Thanks for joining us. I'm going to pass it back to Rachael.
Wonderful. Thank you, Charles. Quick reminder that if you do have a question, you can submit it in the Q&A console. It looks like we have quite a few already and a limited amount of time. So Charles, I'm actually going to go to you first with this question regarding the recent volatility in NVIDIA. Stock we're getting a lot of questions about, and would love to hear your thoughts. Do we believe that this rally is at risk of stalling is the question?
Okay. Yeah, great question. So I think the first thing to consider is that it is quarter end. So the run up in the equity market that we've seen, it's going to cause a bit of a shift in asset allocation as you have mostly institutions rolling up on that Q2 end. So I do suspect some of that near-term volatility is related to repositioning and just risk adjustment in some portfolios. The second component is I don't really see the backdrop in AI changing anytime soon. Now, there has been some chatter about the applicability of the technology, but these things tend to happen in waves. So I think the real risk to the rally is if the baton doesn't get passed to other more fairly valued portions of the market. We talked a lot about that. So we did see some positive rotation into value here recently, and that was on Friday and Monday. And I did talk a little bit about that as well. But we're hopeful the stage is set to kind of see some of that rotation for that baton to get passed off. But right now, when we think about the rally, there's nothing clear cut here that has increased the risk of a stall in the market at this point.
Okay, great. Thank you for that. I know a lot of people have questions specific to tech and NVIDIA. In our last couple of minutes, I'm actually going to move to Mike and get a fixed income question here. So the question is, you mentioned on one of your first slide that muni returns are negative year to date versus other parts of the market. Why is that? How would you explain that?
Thanks, Rachael. Excuse me. Yes. Yeah, we are seeing munis underperform other asset classes so far this year. And I think to understand that, we need to step back to last year. And if we go back to the fourth quarter of last year, we had this impressive rally in the bond market. And we ended the year with munis outperforming treasuries by a little over 2%. And what we saw with that rally was the intermediate part of the muni curve was a strong performer, and valuations in that part of the curve simply became a little bit stretched. And so more recently, with this uptick in supply that we've seen, with the broader volatility in the market, we've just given back a little bit of that strong performance that we saw last year. And we tend to see this change in leadership over time, with munis outperforming in some periods and underperforming in others. But I think the bottom line is, fundamentals in the muni market are still strong, and taxable equivalent yields are going to continue to drive interest in the market.
Great, thank you. And always an important topic on tax management and portfolios. So that's all the time we have for questions. But for those of you who asked additional questions, of course, your portfolio managers, your senior investment consultants are available for any more additional discussions that you might want to have on today's webinar. But thank you all for joining us. a brief survey will pop up shortly in your console, so please share your feedback and suggestions for future topics. We do read those and adjust our webinar preparation based on that feedback. A replay of this session will also be available within 24 hours, and you'll receive an email letting you know how to access it. So thank you again, and have a great day, everyone.